Hey everyone. I always thought listening to Tesla's CFO provides really interesting insights into the company because many of what investors know about Tesla comes from Elon Musk, who, let's be honest, isn't the most unbiased person, who likes to inflate Tesla's prospects and sometimes says things that haven't been completely in line with what the forecasts he suggested would be. For instance, suggesting they would achieve full self-driving back in 2015 and 2016 and again in 2019. And here we are in 2024 and we're still not in full self-driving completely, nowhere near that. And so that's just one example. I'd like to look at the CFO to get more grounded information, let's say. So that's what I did here. I pulled some key information from what the Tesla CFO had to say about Tesla's recent quarter and their prospects. So let's take a closer look here.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the first thing, the most important thing I thought about Tesla's quarter was the decline in revenues, not only quarter over quarter, but year over year. Production deliveries also declined year over year. Now, this is especially bad news for Tesla because it's sold as a growth company, as a growth stock. It's valued like a growth stock. In fact, it's valued like a growth tech stock. It's more expensive than many tech stocks that are growing at a faster rate than Tesla is. It's more expensive than Nvidia on a forward price to earnings ratio. So when you have a company that's valued that expensively and it's demonstrating decreases year over year, quarter over quarter, that's troubling, right? That's really troubling. It's okay to have this kind of performance from a company like a Verizon or an AT&T or some of the other car companies like GM that are not valued like a growth stock. They're valued in the single digit forward price to earnings ratios. So this is something that I was paying close attention to. And what surprised me was the margins, and let's talk about that next. We were already expecting the year-over-year decrease in revenue because Tesla told us what the production and delivery numbers were a couple of weeks ago. So most of the market participants, like myself, knew that its revenue number was not going to be good. It was going to be down year over year. I thought, however, their gross profit margins were going to be way worse than they actually came in. Auto margins declined from 18.9% to 18.5% only. Just a 40 basis point decline here, excluding the impact of Cybertruck. So that's not including the Cybertruck. If you include the Cybertruck, that would have been much worse. But the Cybertruck is just now ramping up, and that's going to be significantly negative gross profit margin for a while, probably for the rest of 2024. So Tesla saying that the impact of pricing actions, in other words, our price cuts, was largely offset by reductions in per unit costs. And more importantly, I think, is this part here, the revenue from autopilot feature for certain vehicles in the US. So they rolled out a feature that allowed them to recognize revenue from this autopilot, and that made the auto margins look better than the underlying factors in the quarter because they were able to capitalize on this feature. Now, previously, they did not have that functionality. So according to accounting standards, they weren't able to recognize that revenue. So this is just an accounting regularity, just an accounting move here, recognizing the revenue from this feature. But if that was excluded as well, just like they chose to exclude the impact of the Cybertruck because that was negative on gross profit margin, but they included the impact of this feature because that was positive for gross profit margin. So a very nice choice of selective reporting here, telling you, reporting a number excluding the negative Cybertruck, but then including the positive for the autopilot feature. So just something for investors to pay attention to in the company choosing to paint this picture. Usually Tesla's not the only one. Nearly every company tries to paint a rosy picture and adjusts their numbers and reports, tries to tell you the things that make itself look better than reporting the things that make itself look worse. So moving on, On the demand front, the CFO talks about taking several actions, including lowering the price of both the purchase and the subscription options, for launching extremely attractive leasing specials for the Model 3 for $299 a month. I don't know if this is extremely attractive. It doesn't look attractive to me. And offering attractive financing options in certain markets. Nevertheless, Tesla cut prices several times in several markets on several models to try and boost demand for its electric vehicles, and still they reported year-over-year decreases. That's what made this quarter look even worse than it was, is not only were the production and delivery, were the delivery numbers down and revenue was down, but this was even after all of these incentives that they tried to push into the market. And then on top of that, there's all this government incentive into the market to try and make sales of electric vehicles more attractive. And they're just not. They're just more expensive than comparative models, especially when you look at the total cost of ownership. If you look at how much extra time you have to spend on charging your vehicle, especially if you're not one of the fortunate few that has their own home that can install a charging station at your home, which again costs thousands of dollars to try and lower your time for charging because you could charge when you sleep, all of which is making ownership of electric vehicles unattractive for most people. More than 9 out of 10 people, I keep saying, are choosing internal combustion engine vehicles. So the price of these needs to come down much, much more. The charging infrastructure needs to be much, much better in order for the supply and demand imbalance to rectify itself for this industry. Now, the bright spot for Tesla was the energy business. The energy business continued to make meaningful progress with margins reaching a record 24.6%. And they expect the energy storage deployments for 2024 to grow at least 75% from 2023. That's great news. That part of its business is doing well. And that part of its business is expected to continue doing well. And that's to be understood, right? If you make more sales of your vehicles, the demand for energy is going to increase because you need to charge these vehicles. And the more and more you need to charge these vehicles, the better it is for Tesla. So that's a positive part of its business. Part of its business that I think doesn't get enough attention is this recurring stream of revenue and profits that Tesla will generate if it can sell more electric vehicles, because those electric vehicles need to charge, and Tesla has arguably the best charging infrastructure of anybody around. And you could see evidence of that with most of the large OEMs partnering with Tesla for its charging infrastructure. And so the more of these EVs on the road, the better it is for Tesla. The problem is that EVs are not expanding at the rate at which Tesla and other participants were hoping for. And that's with all of the thousands and thousands and trillions of dollars macroeconomically that governments have tried to put into the system to incentivize both suppliers and buyers of this technology. So imagine what the demand for electric vehicles would be like without all of that government incentive. Imagine what demand would be like. So that's what really has me troubled and concerned about these EV stocks, is they're struggling for growth right now, even with the trillions of dollars of government stimulus flowing through the system. I'm really skeptical to see what demand will be like when that incentive is reduced or eliminated from the system, because the governments can't continue spending trillions of dollars on this, trying to support this industry indefinitely. They can't continue to do that. And so that's going to be a key thing to pay attention to. Can the industry stand on its own once government incentives are removed? Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.